Aloha! Hey, it's Julie Zimles from 365 Hawaii, and I am here with Marla and Scott Wynn from the Wynn and Eagan Team, Citiwide Home Loans, and we are doing our little mortgage update. And because so many new people have actually joined our group on the Facebook page, we're going to do a little bit of some of the basics. And so the people who are actually here over on YouTube who are watching, this is going to be, not only are you going to hear what's happening locally and also what's on trend, but also kind of some of those things you need to know about if you're going to get a mortgage in the future. And if you are on YouTube and you really wish you could be in on the live experience like my people on Facebook are, please consider joining our Ohana. And you can do that by going to movetohawaii365.com and click the Join Ohana button, and you'll get a chance to get into all of our different groups that are private, and also you'll get into an email stream that gives you tons of information about buying a home on the island. So let's get started with our people over there. As you guys are hearing what we're having to say, please put your questions in and we'll answer them live. So let's get started with 2022 basics for our new members. I'm seeing lots of new members coming. They're saying they're coming in late 2022, early 2023. So knowing you've got that much time to kind of get a running start, I wanted to ask these guys about what is the best plan of action for you at this point, knowing you're coming. So I think, Scott, you wanted to handle this one?
Sure, I can take that.
Give them the game plan.
Sure. So normally we recommend getting started on the mortgage process as soon as you possibly can. And I know that that might just sound like generic advice, but I want to explain a little bit why we think that that's an important aspect, is that mortgage qualifying, even though you may be or consider yourself very well qualified, maybe have a really good income source, maybe feel like you've got great credit, great assets, or even if you don't, sometimes it might feel as though you're not going to have any problems in the mortgage qualifying process. And I can't tell you how many times in our experience we jump into an application and we start looking at it from a mortgage qualifying perspective, which is very different than just your own personal feeling of how your finances are. And in many cases, we have issues that we need to work through. And rather than waiting until the moment you find a particular house that you're ready to make an offer on to uncover some of those things, we think it's important to try to uncover those things as soon as possible. So just to share a few examples, right? So, really the three big major pieces of mortgage qualifying come down to credit, income, and assets. And if we are going to run a credit report, there may be some things on there that you don't even know are on there that might be impacting the credit score, or maybe not impacting the credit score, but impacting credit qualifying. Because even if you have a fantastic credit score, there might be something on the credit report that could impact your ability to qualify for a mortgage that needs to be cleared up, right? Mm-hmm. And you may not be aware of that because you're only looking at the score through credit monitoring services like Credit Karma or something like that. Mm-hmm. And that gives us the opportunity to uncover that and resolve it prior to getting a house in mind and then having to work through it at that particular point. Sometimes people have unique income sources, commission, self-employment, and things like that that can impact the ability to qualify. And if we can work with you to figure out what the timing requirements are, what the actual income calculations are for mortgage qualifying, then that will also help us in figuring out what the price point is and making sure that you're shopping in the right price point and such. Mm-hmm. Even assets, down payment, closing costs, and what we refer to as reserves, which is the available money after closing, mm-hmm. are another aspect of assets that is important to understand ahead of time so that we can start working on a plan to figure out what we need it to be or what's going to help you get a slight bump up, right? So if having one more month of reserves is going to help, or boosting your credit score 4 or 5 points is going to help you a little bit more, those things that would be helpful to know as early on in the process as possible. So I recommend people getting going on the mortgage process as soon as you possibly can and are aware you're planning to make a home purchase.
I'm going to piggyback on that a little bit because I think that talking a little bit about the difference between owner-occupied second homes and investment properties fits in really well here. We've worked with a lot of customers that own multiple properties and they plan to just come here and buy one and liquidate one of their other properties. That's one example. But depending on the type of property is and the type of property that you're purchasing, that doesn't always work as easily as you would think. I mean, if you're well set in your finances and you have multiple properties, you're probably one of those people that thinks you're super qualified and won't have any issues, but we can run into issues just based on guidelines that we have for mortgage qualifying. So that's one thing. And if you're going to purchase an owner-occupied property in Hawaii, you're going to need to have an income source that's going to continue once you relocate to Hawaii. So you have to have a mainland job that's going to allow you to work remotely, or you have to have confirmed and verified employment on the island. If you're purchasing a second home here, and that's a home that you're just going to live in, you are not planning to rent it out at all, You can lend it to family and whatever, but you can't rent it out for profit. You can purchase a second home and use your mainland income, but you have to count both house payments against you, obviously, so that might be a debt to income ratio issue. And then if you're purchasing an investment property because you plan to rent it out, you can use your existing income as well, but those down payments might be slightly higher. So those are all things I think that are really important to talk about. And if you can get into the process well in advance, it can be super helpful.
Right, and then also you're not making mistakes that end up costing you later. I think someone in our group mentioned that they had to, liquidated something, and then it ended up getting a tax that they weren't prepared on. And some people are trying to do it right, and then also 1031 exchanges. Sometimes people think, oh, I'll just take it over here and go over here, and then you realize it's not like by like, and they can't get it, ahead of time. So these are all,
and it has to be within that specific time frame too.
45 days, and sometimes people can't get that happening. So one of the things that I think that what's great about this team is that they've got a special agent called Joe, and and he is like this total whiz on helping people with their financial strategies. And because some people, it's not as easy as saying, well, do I qualify for a loan? I think sometimes people say, I've got some assets over here, and I've got some debt over here, and I've got this going over here. He goes like this, let's figure this all out. And he gets a picture that you can say, okay, what makes sense most financially? Right. And, he's helping us too, and I just, it's Joe in the hole there. But
it's not
also
just about getting qualified, about optimizing the approval, right?
Right.
So figuring out what's best for you, and also what's best for the mortgage, so that you get the best possible terms you can, while also making sure that it fits into your strategy as well. So.
Right. There you go. So with that, we were going to talk a little bit about the market is hot still, and plans on being hot at least until the summer. And so coming in with a pre-approval to get that bid.
So you want to talk a little bit about the difference
what's the
between
difference,
pre-qualification, pre-approval,
and how important is it?
Yeah. So I don't know of anyone who's gotten an offer accepted that's financing without being at least pre-qualified. So I'll tell you a little bit about typically how we work, and the agents that we work with and how they work. Typically we'll do a pre-qualification upfront, so that's just completing an application, whether you could do online or over the phone with us. We run credit, we run automated underwriting after we've gone through everything with you. Then we send you a list of documents to collect in order to verify everything in the application. And at that point, we have a conversation about all the different loan programs you qualify for, what's the best way to structure it. And at that point, you're pre-approved. But prior to you receiving your documentation, we can issue a pre-qualification letter as long as it's pretty straightforward income. If you're a self-employed individual and we need to review your tax returns, that's probably not going to be something we're comfortable with, because we want to make sure that we can count the income that you count, because that's different. But so we'll get a pre-qualified buyer. Typically, an agent can submit an offer with a pre-qualification letter, but then it has to be followed up like pretty much right away with a pre-approval. Would you agree? Yeah. They don't want to accept an offer on just a pre-qualification because it is so competitive. They've probably got 5 or 6 offers, and if somebody's pre-approved, that might have a little bit more.
So pre-approval basically is money in the bank.
Totally.
It says, you know what, these guys, this is what they qualify for. Right. They can come up with this money tomorrow if they need to.
Right.
Well, let me clarify that a little bit. Because a pre-approval is not necessarily money in the bank, depending upon who the lender is that's issuing the pre-approval, right? Pre-approvals are somewhat open arbitrary in terms of the terms by which they issue a pre-approval, right? So I don't know, maybe some of the audience has seen that you can get pre-approved within 5 minutes online. Right? That's not the same pre-approval as what we're talking about in terms of a pre-approval.
Right.
So sometimes lenders will use the terms pre-approval and pre-qualification interchangeably, even though in the industry it's really known that a pre-approval is better than a pre-qualification. So
that was good to know, just so you guys know that that's important.
It's very important to understand that your pre-approval is a full pre-approval. And we actually go one step ahead and call them rock solid pre-approvals, and we explain that on our pre-approvals that are given out when they submit an offer. That says, to the degree in which we've done the qualification process, that we do have a loan application, a credit report, automated underwriting approval, we've collected documentation, we know without a doubt that this person is qualified, and so that is money in the bank. But if a lender has just taken an application, run it through automated underwriting, they may call it a pre-approval, but it's not to the degree that our pre-approvals are. So you just got to make sure you understand what it is, and that your letter states the degree to which the lender has gone through for the pre-approval to help strengthen your offer when you submit it.
Most agents on the island, I believe, that are representing sellers don't like working with online lenders, and will
like
not.
Rocket.
They'll put those at the bottom of the list if you're not working with somebody local.
Right. And
just they've been burned a lot of times.
Right. And some of these people who are on our group are kind of new. I don't know if they really understand how it's really important to use somebody who understands how to get mortgages in Hawaii. I've a couple people have said, I'm bringing my Wells Fargo or, American Savings or whatever. And everyone kind of yells all at the same time. No. Make sure you use a Hawaii lender, right?
Yeah.
And because just, again, there's like 2 or 3 reasons why you want to use a Hawaii lender. Lava Zones is one.
Lava Zones is one. Another thing that's different here is the recording date is after the funding date. And so that typically happens 2 to 3 business days after it funds. So that was something we had to get used to when we started doing loans in Hawaii, was we had to send our money days ahead of that deed recording. And so that was just an adjustment. And so a lot of lenders don't know that. And so they don't get the funds there on time to close. And so it delays closing.
It's relationships with appraisers, though, also, right?
Mm-hmm.
It's relationships with title companies. It's relationships with the real estate agents.
Mm-hmm.
Because as we do more transactions and local lenders do transactions here, it's a small town and people get to know one another. And there's a reputation that's built there, either good or bad, right?
Mm-hmm.
And an online lender or somebody that doesn't have that won't have that kind of
Yeah,
clout,
I love
if you
calling
will.
listing agents that we work with. Hey, we have a buyer that submitted an offer on your listing,
Yeah.
and they already know we're great. So
Yeah, that's right, because they know they can trust you,
Yeah.
that you're going to close a loan,
Right.
which means they can get the deal done.
Right.
Okay, that's important. And just real quick, Eric, is there anybody that's asking questions and stuff? Go ahead and put questions in there. Okay. So let's talk about interest rates real quick, because a lot of people believe that, and you guys probably have heard, the interest rates are kind of on their way up. The government says they plan on raising interest rates to slow down inflation. How does that affect mortgages?
So this is a tricky
Scott loves
question to
this
answer,
one.
right? So what Julie's referring to is the Fed funds rate. And the Fed funds rate and mortgage rates are not necessarily the same thing. Well, they're certainly not the same thing, but they are correlated to the same data that impacts those rates. So just to clarify, Fed funds rate is the rate at which banks lend money to each other overnight. Mm-hmm. And so that's very different, of course, than what your 30-year fixed mortgage rate is going to be. Generally, when the Fed funds rate changes, those are going to impact things like auto loans, student loans, credit cards, things like that that the banks are offering. As far as mortgages are separate from that and exchange on a secondary market separate from how banks get their money. But the data that impacts the Fed funds rate also impacts mortgage rates. So those are things like consumer spending and unemployment rate and the general economy and how well is it doing. And so the better the economy is doing, generally that's going to increase interest rates. And the worse it's doing, interest rates go down.
Right.
That's why we've seen really low interest rates, because we've had a few different things going on for a while and keep, like with COVID and all the impacts of that, right, is kept interest rates low for quite a long time and extraordinarily low. Mm-hmm. So the Fed anticipating and basically telling all of us that they're going to increase rates in the next year.
You're fine now.
Basically means that they expect the economy to continue to improve and therefore rates are going to go up. And so the same thing is most likely going to happen with mortgage interest rates. Most of the projections I'm seeing are that by year end of 2022, we're probably going to see rates in the mid to high threes.
High threes, which is still pretty good. Yeah, it's
Yeah.
pretty good. Okay, so that's okay. That was the elephant in the room of people wondering, oh my gosh, if I lost the opportunity to still get a decent mortgage because now the interest rates are going to go sky high. They're not.
Right.
Okay, that's
Still,
good to know.
yeah. The longer you wait, the higher prices are going though too.
Right. See, that's true too. So,
Yeah.
and if you guys ever want to do a really interesting thing about a mortgage calculator about how even a quarter of a rate could raise your monthly payment by a couple $100. It matters how big the mortgage
depends on the
is.
price and all that,
Yeah.
exactly.
Yeah.
But
Okay, so get this. So as we've been talking about the hot market here, appraisal gaps and the appraisal aspect of life. Do you want to hit a little bit about what's going on here with the appraisers and what you're seeing with
Yeah. So this summer, spring and summer, we saw a lot of appraisals coming in at market value because that is the value of the property, what the appraiser brings in. But they were coming in below the contract price or purchase price.
Mm-hmm.
So we saw a lot of appraisal gaps. So when they would submit an offer, they would say, we'll pay up to $20,000 over the appraised value if it comes in below the purchase price. So we saw a lot of those through the summer and even early fall. But now we're starting to see appraisals coming in more at the purchase price. And one of the things that drives that, and you can expand on this too, because I think he's really good at explaining it, but appraisers can only use comps to substantiate the value. And if the comps don't ever increase, then they really can't increase the price of a property on an appraisal. But because we did have appraisal gaps and people were paying cash and they were paying over the appraised value, then eventually it does raise the price of everything because the comps go up.
Right. Okay.
I guess one way to look at it is that generally when a real estate agent is pricing a home to list a home for sale, they're generally working forward, meaning they are looking at the market, they're looking at the activity in the market, they're looking at homes that are like your home that are for sale but haven't yet closed, and kind of getting an assessment of what they think they could sell the home for. They're trying to get top dollar, right, for the seller. The appraiser, on the other hand, has to work in the exact opposite direction. They have to work backwards, and they have to prove that homes like yours have closed at a particular price, and how does it compare to your home? So the real estate agents and the appraisers aren't necessarily looking at the same data, first of all, and then not only are they not looking at the same data, but they're looking at it from different angles. And so sometimes it can be challenging for those two to line up. Now, sometimes they do, like we're seeing more now, but not necessarily always the case.
And sometimes appraisers, because of lender requirements, have to look at different comps than the listing agent looked at when they priced the home. So, it has to be within a tighter radius or with, a shorter sales span or something. So there's always maybe a little bit of discrepancy there.
Yeah, and what we're seeing is, at least lately, the sellers are starting to still think that they're going to get a lot more than what their neighbor just sold their house for 2 weeks ago, and so then they've got that where you've got that how hot is the market? How much could I ask for? So that's so interesting though.
Whatever the market will bear.
Whatever the market will bear, and that's happening. So it'll be interesting to see how we go after this the Christmas season into what's happening with our all the homes selling at list price. Right, instead of having extra $200,000 thrown over the top at it. So, okay, then, so let's talk about keep going with local trends. What are you seeing in the local market in terms of people needing financing? And what because last month when these guys were reporting out, they realized that they weren't financing condos at all. So I asked Marla to kind of say, what's happening now? What are people needing mortgages for, and what's the trend?
Well, in January, we're 50-50 condos and single-family homes.
50-50. Okay, because that was totally not. It was like 100-0.
Well, and I want to say too that our personal experience doesn't necessarily mean that is the market in West Hawaii. It's just that based on the people that we work with, that's what we're seeing.
Yeah, but that's an interesting. It means that money's financing is coming back into the market.
Well, I think Lance said that 60% of homes were financed in November. Right? Single-family homes. So 60% were still being financed. So I haven't gotten December numbers, but I think that's good.
Yeah. It means that obviously, where we're having this conversation is that yes, if you need financing, you're not going to be, not completely cash buyers on the island right now, right?
Right.
Okay, and then Q&A, anything? We always like to check to see if anyone has any questions.
We have a good crowd, first of all.
Oh, we have a good crowd. Thank you, good crowd.
They haven't asked any questions yet, though.
Okay, and the good crowd could,
I must mean we're doing a really good job explaining.
Yes, that's awesome.
Any questions?
So, okay, so in general, because if you guys are asking questions, we're going to just, kind of shoot it over here. If you are coming and thinking, oh boy, I'm going to get myself a nice $500,000 condo, let's just say, because that's what I think the average right now is around 500. We're watching one of our clients struggle with 5% down right now. 5% down is a little low for the competitiveness of the way the market's running right now.
It can be, but doesn't it say, wow, cool, they got him with only 5% down?
Yeah,
that's awesome.
But they're in there. But what's like the average? 30%? I mean, what are people like? What do they need? I
didn't run that number honestly. Yeah. And we do single family homes, we do condos, we do owner occupied, we do investment properties. So like it's just kind of all over the board how much they want to put down. But I would say generally people that are buying second homes are putting between 20 and 30% down. Okay. Owner occupied someplace between 5 and 20 typically.
Okay.
And then investment properties 20 to 30.
Okay, that's good information. I mean, that's what people have like a ballpark of what they should look at, right?
Yeah, I think just have to say again, like if you're coming, get pre-approved first before you come. I mean, and one reason to do that is because you have access to all your documents.
Oh yeah.
Like once you
yeah.
come here, you might not have, unless you're like my husband, he has everything digitally, you might not have access to the things that we need in order to issue a pre-approval. And then you're here for a week or 2 weeks. We can't issue a full pre-approval without that information.
In fact, that happened
So-
recently. We had a gentleman come in and he was so excited because he got a chance to be on vacation. They immediately said, I'm going to buy a house. And the first thing was like, well, we need all your documentation for your mortgage. And he's like, well, it's all at home. And well, you're not getting a house. So that's happens too. And then also to get all that information, just in general, I mean, there could be some first-time home
Timeframe?
buyers here.
Yeah,
How long does it take to get all that stuff together?
Well, it depends on who you are.
Yeah.
If you're my husband, you'll have it together in 5 minutes
He's like,
because he
"I got it
knows
all
exactly where
digitized."
it's at.
The rest of us are
But-
filing, going through the file
Yeah.
cabinets, looking.
But it's not really that extensive of a list. I mean, typically we need a copy of your ID. That's probably in your wallet, right?
Okay.
Paycheck stubs, bank statements, tax returns, and W-2s, and then maybe not even sometimes, depending on what we get with automated underwriting, which is why typically we have you do the application first, then we run credit, then we run automated underwriting, because if they say we just need 1 year of tax returns, we're not going to ask you for 2.
Oh.
So there's, those requirements. I was thinking about something else too I wanted to say, and I cannot even.
Okay, we got the appraisals.
I'll just add to something real quick, which
Okay.
is, I mean, one of the benefits of working with a lender as soon as you can in the process is to utilize them as a resource, right?
Mm-hmm.
I know that there is information everywhere, right? I mean, you can do a Google search for mortgage qualifications and you'll find, 20 million websites that can give you information, right? But what they're not going to be able to share with you is what's particular to you. What's particular to you is going to be able to be answered by an individual loan officer looking at your unique situation and giving you the advice that's particular to you for the documentation that's required, for the credit adjustments that need to be made, to the qualification of income, all those sorts of things. And no matter how much research you do, there's no way you'll be able to identify that without actually talking to a loan officer.
Right.
And I know it can maybe feel a little bit scary to people to start talking with a loan officer. And I mean, a loan application for a mortgage is very different than a loan application for a credit card. We've all got those credit card offers that come in the mail, right? That say you're pre-approved for a credit card offer of whatever, right? And you fill out the information, you go online, you fill out the information, and then you wait for the response of, did I get approved or did I not? And if so, how much? That is not how a mortgage works at all. It's more of a consultative approach.
Mm-hmm.
You complete a loan application to get us the information so that we can then advise you on how to improve that situation, or what the best loan program is, or how to make a tweak here to make it even better. So it's not like you submit your application and it's a yes or no.
Mm-hmm.
It's a submit your application and then we work together to give you the best possible solution we can possibly provide to you based on your unique situation.
Yeah.
So working with a loan officer, I think, can be very, very valuable.
Yeah.
And again, sooner in the process.
And
you
if
can do it.
if a buyer doesn't have the exact qualifications for what they're trying to accomplish, we'll help them brainstorm ways they might be able to get there, like getting a cosigner or taking a 401k loan for down payment or closing costs. So
or getting a gift, or
there
lots
are
of different ways.
lots of different solutions, and it's our job to work with buyers to help them achieve their goals if possible. So it's not the one and done. That thing I was going to mention too is that our pre-approvals don't expire. Your documentation gets old and we have to update it. And your credit report does expire after 120 days. But as long as you don't change anything in your finances drastically, like we can just continue carrying your pre-approval on. And then once you find a property that you're interested in putting an offer in on, we'll update it at that point. And we'd have to run credit again before you close,
Right.
but we don't do it every time it expires.
Right,
So
right.
like you can do that if you're coming in 2022, the end of the year, or early 2023 or whatever, there's no harm in letting us do that for you and help you through the process and give you a plan.
Right. Yeah. And at 6 months in advance is, I mean, I've seen people do it a year and a half in advance.
Yeah.
So to me personally, I don't think it's ever too soon to get some financial advice and
Yeah.
get a game plan and a goal set up so that you can hit this thing running strong.
Right.
You were asking about timing. I mean, we've had people contact us in the morning. They weren't necessarily in a hurry, but they had all the information readily available. And from conversation in the morning, we had them pre-approved, fully pre-approved by the afternoon.
Oh, okay.
That is possible.
Mm-hmm.
Now, on the other hand, we've had conversations with somebody, and based on their circumstances, it just wasn't the right time, and we continued to stick with them and help them out. And it was 2 years or 3 years later that they finally ended up making a home purchase. And we're on your timeline, right? I think sometimes it might feel like you're going to get a lender that's going to pressure you to close once you contact them, and that's not our approach. This is a huge purchase. This is a big transaction, and it's up to you to decide when it's right for you. We're just here to help you along that journey, and if it's going to take 2 days to get the documentation, great. If it's going to take 2 months or 2 years, that's fine too. We're here to help you get to the end goal that buying a house. So
Love it, love it. In fact, I put in the group a couple days ago that Eric and I, well, Eric right now because he has his license, but I'm getting mine too. I have my paperwork. I will have my license by next month. But we've been asking people if they want to get on a listing alert to get on one now so they can all start looking for homes. But that's kind of like putting the cart before the horse a little bit because they don't know what they qualify for.
Yeah,
They
but I
think they can qualify for a $600,000 house.
True.
But maybe they could actually find out they can actually qualify a little bit more by getting the right information. And then that way, those listing alerts, when they get that information, it sets their expectation for the kind of house they can afford.
Right.
And let me add to that a little bit, because when we purchased our house here, right, Hawaii real estate is very different than most other markets that I've ever seen. I mean, coming from Colorado where we lived, most houses were pretty darn similar within a particular price range. If you were looking in the $600,000 price range, you're not going to see much difference in the entire Denver metro area between $500,000 and $600,000. Pretty much all the houses are the same. Here, that was not our experience whatsoever. There could be a house priced at $600,000 that is nowhere near something you want. Maybe it's too close to the ocean or too far from the ocean, or maybe it's too much in the city or whatever it might be, right? And there are vastly different properties all within the same price range. And so being on a listing alert kind of gives you an idea of what might be available. But what I'll also point out is that until we found the house that we live in now, we weren't really finding anything. But once we saw that house, everything clicked for us. It was like, that is the right house, and that's ultimately the house we bought. What you don't want to have is being on listing alerts, looking in and going, oh, there's nothing really there for me. And then all of a sudden one popping up and going, that's the one, and then not being prepared.
Yes.
Right?
And we've
So-
seen that actually happen
Yes.
quite a few times. Because then they go, oh, that has the, the amazing view with the Ohana income from the bit below. And, oh my gosh, there's a dog run and it has all the thing I needed. I wish I would have done this sooner.
Right.
So, yeah.
I'm going to ask Scott a question. I'm going to have you address this just because I think you're really good at explaining it. But we know our strengths. So one thing that I hear a lot from buyers is, well, I'll fill out the application, but I don't want you to run my credit because I don't want it to negatively impact my credit.
So I think generally what I see is it's people with really, really, really good credit, let's say 780 credit scores or above, generally seem to be very concerned with their credit. And they're worried about the impact that that's going to have on their credit. The more qualified you are from a credit score perspective, the less it's going to impact you. Like we've seen as little as a 2-point hit, maybe a 7-point hit on your credit score. And if you went from an 800 to a 793, it's going to have no bearing on your mortgage qualification whatsoever. Because generally once you hit like a 720, 740 credit score, you're qualifying for maximum benefit anyway. Okay. So at that point, what's the harm in at least having it checked so that you know what the situation is? And on the opposite end of the spectrum, what I find is that people with the lower credit scores are most concerned about having their credit score run and credit report run. And yes, it will have a detrimental impact to the score more so than the higher credit score customer. But we need that information in order to be able to help you and advise you on how to get the higher credit score, right? So either way, you either need it or it doesn't really matter, so might as well get it so that way we can uncover anything that goes along.
Right. Yeah.
The other thing is that you can get free credit reports. You can run your credit report online for free as a consumer once each year. And you can get that information, and that can be somewhat helpful. But some of the tools that mortgage lenders have, including us, is we have credit analyzer tools and what-if scenario tools that our credit reporting company offers. So maybe you have $5,000 to work on your credit. We can plug in $5,000, and it will optimize the exact strategy to boost your credit score to the absolute maximum you can get based on that amount of money that we have to work with. Or on the other hand, we can say, well, I want to pay this account off. What will happen if I do? Or I want to reduce the balance on this credit card. What will my score do? And we have those tools. Whereas with the other option, we can't really do that.
Right, because sometimes people wonder, should they just close out all their credit card?
No.
And
Don't ever do that.
Okay, see, so and most people, I don't want to look like I have extra money running around. So if I cut it off, then it looks like I have more money, and then that's not always the smartest thing to do. Yeah, and buying a brand new tracker before you come to Hawaii is probably not a smart idea when you're trying to get a mortgage. Either,
Don't buy a car for your new garage until after you're in your house.
So James has a question. So she said, I joined a few minutes late. I'm sorry if this has already been covered. Scott, you mentioned that the rates are projected to be in the high threes by late 2020. What are the rates currently for owner-occupied property assuming a high credit score?
Sure. So the best resource for average credit scores nationwide is what's called the Freddie Mac Rate Survey. So they do a rate survey of a variety of different lenders throughout the entire United States on a weekly basis, and then they publish those results on their website. So if you just look up Freddie Mac Rate Survey, that's a great resource to get a general idea of what the trends are, what it's done in the past, what it's doing in the future, and so on. I think it comes out every Thursday. So last week's, I think we were sitting at 3.22%. And that was with 0.7% in fees, so lender fees. These are going to be like origination fee, underwriting fee, processing fee, those types of fees that a lender might charge. So 0.7% in fees. And that's, again, an owner-occupied home, I think 20% down, 760 credit score or something like that. So hopefully that gives you a general idea of where they're at right now.
And that those are in arrears, basically.
Yes, and
right?
that was a week ago. So it's probably slightly higher at this point based on how things have been trending. And so many different things impact that. I mean, I think at one point I looked up all the different things that can impact interest rates, and it was like 62 different things can impact interest rates. Oh. So that might be the average for that particular scenario that they ran, but they're not factoring in property type, they're not factoring in other things that might impact interest rates.
That's good. That's still a pretty good low interest rate to get yourself involved with. We're getting the Eric Zemalist tap. So we're going to go ahead and, unless there's any further questions over here, we're going to wrap it up. And for people on YouTube who are going to see this over the next, however long, go ahead and either leave comments for us and we can have these guys answer them, or just go right to Marla and Scott directly with your questions about having a mortgage. Can you share your information? And I'll put it down below in the YouTube, but go ahead for these guys.
Yes, so my cell number is 808-450-2561. You can email either of us at either mwynn@citywidehomeloans.com or swynn@citywidehomeloans.com.
And our website is lendingahand.com.
Right, and they have a really good blog too for some of the people who are just thinking about moving to Hawaii too. It's called
Calling Kona Home.
Calling Kona Home. And Scott is a really good and insightful writer. Some of the stuff I've written now, I'm kind of jaded because I've been here for so long. They still have the fresh stuff. But the people on YouTube, go ahead and don't forget to go to movetohawaii365.com and do the Join the Ohana group, and you'll get all kinds of great resources. And we like to do these things probably at least once a month. And we have the market update once a month, and then we have these guys probably once every quarter.
Yep. And
again, it's a great beneficial service. It'll save you thousands of dollars in the long run, headache, and you know what? I was reading something today about quitting, that if you are determined to make this happen,
it will happen.
It will happen, knowing that Eric and I have created this resource and nobody else is doing this. So the quitting is quit thinking you're going to find information someplace else that's better than ours, because you're not. So go ahead and hang out with us and join our 365 Ohana.
So in a parting comment, Lauren says, just wanted to say I had a great experience working with Scott and Marla.
Aw, thank
Yay! And there's lots of testimonials for these guys too. So with that, we will say goodbye. Thank you guys very much for your input and your expertise, and we will see you guys next time.
All right, aloha!